it's not our natural inclination to sell. And on the other hand, and we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. And we've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been an American Express one in the 60s in Disney. So there are companies we're familiar with. We would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. That 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort, we probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future. We think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree. A classic case on that would be the newspaper industry generally, for example. I mean, in 1970, if Charlie and I were looking at the newspaper business, we felt it was about as impregnable a franchise as could be found. We still think it's quite a business, but we do not think the franchise in 2002 is the same as it was in 1970. We do not think the franchise of a network television station in 2002 is the same as it was in 1965. And those beliefs change quite gradually, and who knows whether they're precise, whether they're right even, but that is the reason in general that we sell now. If we got into some terribly cheap market, we might sell some things that we thought were cheap to buy something even cheaper after we bought lots and lots of equities, but that's not the occasion right now.
Yeah, when I started out, the sell situation has changed over the years, because when I started out, I had way more ideas than money. I mean, I would go through Moody's manual. I went through it page by page, and then I went through it again page by page. And I found stocks in there that I could understand that were selling at like 2 times earnings, even 1 times earnings. Well, when you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas. So if you look at our annual report, which is on the internet at our homepage, BerkshireHathaway.com, you'll see something in the back called the Economic Principles of Berkshire. And you will see, which I believe in setting out for my partners. They are my partners. I don't look at them as shareholders. I look at them as partners. They're going to be my partners for life. So I want to tell them how I think. And if they don't agree with the way I think, that's fine, but I don't want them to be disappointed in me. So I lay out there and I say, in terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for. I mean, if somebody offers us 3 times what something is worth, the See's Candy, the Buffalo News, Borsheim, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I own 100% of Berkshire, because that's the way I want to live my life. I've got all the money I could possibly need. It just amounts to a change in the newspaper story on my obituary and the amount of money the foundation has. And to break off relationships with people I like, people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me, that'd be like selling one of my children. I won't do that. And I want to tell my partners I won't do it, so that They're not disappointed in me. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged, perhaps, with the management, or we think the economic characteristics of the business change in a big way. And that happens. So, but we're not going to sell simply because it looks too high. Yeah, in all likelihood. I mean, you can't make that 100%, but it's principle under which we're operating. We're generating right now $5 billion of cash a year at least. So it's $100 million every week. You know, the real question is, how do you put it out intelligently? And if we were selling things, it'd be just that much more. So there may come a time when that changes. But we want to, and I have partners, shareholders, partners, who would say, if you can get 3 times what See's Candy's worth, why don't you sell it? And that's why I want to be sure before they come in, they know how I think.